Donald Trump threatens 30% tariffs on the EU and Mexico from August the 1st, which may slow US growth and push up inflation. China is due to report a swathe of data suggesting 5% growth in 2025 is still possible. And India is expected to report benign inflation figures later today. That's coming up in our 5 Things in 5 Minutes on Monday, July the 14th. And then in our deep dive interview, ANZ Economist Sophia Angala looks at how Australia's states performed in Q1.
The nationwide performance was dragged down by a deceleration, so that's a loss of economic strength in momentum in Queensland and Victoria.
But first, in 5 and 5 with ANZ, Donald Trump threatened tariffs of 30% on the European Union and 30% on Mexico on Saturday after the US markets closed. He also threatened 35% tariffs on Canada. Here's ANZ economist in London, Bansi Madhavani, speaking overnight on what that means.
Together, these three trade partners account for nearly 47% of the US's imports. At this stage, it is unclear if the USMCA-compliant goods will form part of tariff framework or will they remain excluded. If these tariff levels stick in their current form, it is likely to push the US's effective tariff rate above 25%. That compares to just 2.5% at the start of the year. What such a tariff level will do is that it will increase downside risks to the growth outlook and meaningfully increase upside pressure on the prices.
As of 4 a.m. Sydney Melbourne time, the S&P 500 closed down 0.8%. The 10-year US Treasury yield rose 7 basis points to 4.41%. The 30-year rose 9 to 4.95%. Gold rose 1.1% to $3,364 an ounce, while West Texas Intermediate futures were up 2.8% at $68.45 a barrel. The US dollar index rose 0.2%. The Aussie dollar begins the week at 65.80 US cents, and the Kiwi starts at 60.12 US cents. Number 2, Bansi says markets will need and will be watching for more information out of Trump.
We're watching for two things in the coming week. One, do such tariff threats manage to alienate trade partners, and will we see any retaliation from them? The second thing to watch for is the financial market reaction. So far, financial markets were optimistic that the worst case outcome of the tariffs would be avoided. Now, do the weekend developments manage to dent that optimism, and will we now see renewed volatility in financial markets?
Number 3, China is expected to release key economic data for the second quarter today and tomorrow, which is expected to show it can remain on track for its 5% growth target for 2025. Here's ANZ's senior China strategist, Zhao Pengxing.
The growth pressure has been eased significantly. We expect the policy focus will shift from short-term stimulus to long-term structural reform. So the challenges in the second half of the year will be structural, such as deflation or demography. We expect the authority to take very strong efforts on the fight against the deflation, and China may also launch new birth subsidies for households.
Number 4, India is expected to report lower annual inflation later today, which gives the Reserve Bank of India space to cut rates again, says ANZ economist in India, Dheeraj Nim.
Food inflation remains quite benign overall, and we expect this trend will continue because monsoon progress has been decent, so food prices have been rising sequentially, but not in any extraordinary manner to cause any concern. Therefore, headline inflation is expected to remain benign on account of food inflation. In fact, it is indicating for further space for monetary policy easing, as many MPC members have recently remarked that if inflation undershoots the target, more space for rate cuts can open up. We still expect one more rate cut to bring the repo rate down to 5.25% by Q4 of this year.
Number 5, New Zealand's manufacturing sector contracted in June for a second month running, according to the Business New Zealand BNZ survey reported on Friday. ANZ economist Matt Galt says it shows momentum in the recovery from earlier in the year is fading.
Before that, we'd started to see a bit of a tentative upturn and recovery in the manufacturing sector, but that seems to have stopped completely in the last couple of months. And that suggests a little bit of downside risk to New Zealand's GDP, to our GDP growth forecast for Q2. The QSBO suggested that manufacturers are seeing weakness in both their international orders and in their domestic orders, although more so in their international orders. So possibly all the tariff disruptions had an impact on manufacturing demand, but more broadly it just seems that the New Zealand economy stalled a bit over the last 3 months across a wide range of indicators.
Matt Gold there. Now, in our deep dive interview, ANZ Economist Sophia Angala analyses how Australia's states performed in the first quarter and what it means for their fiscal positions.
So the Q1 ANZ Statometer showed a mixed bag of growth in Q1. You saw that there was an acceleration across most states and territories, meaning economic growth was picking up at a faster pace. The nationwide performance was dragged down by a deceleration, so that's a loss of economic strength in momentum in Queensland and Victoria. And these two state economies also saw below trend economic growth relative to their long run average. So in Victoria, what drove down the index in the Q1 ANZ Statometer was a decline in the labour component of the index. So in Q1, Victoria had the highest unemployment rate nationwide of 4.5%, but that's since declined to 4.4% in May. But on the other hand, when you look at the Queensland index, all components or sectors that make up the Statometer index, so that's business, consumer, housing, labour and trade, they all saw a decline in Q1. So the Queensland index across its components saw the largest fall in labour. So Queensland saw the weakest employment change nationwide, where it saw employment decline versus a rise in that same measure nationally. And you also saw that the housing component weakened as the pace of Brisbane's housing price growth eased from in Q1, where you had that population growth, which has supported that housing price strength in recent years and that robustness, where you saw that robustness and housing price strength in recent years has been supported by population growth, and that's since passed its peak and steadied at 2.3% year on year in Q1. But I note that is still above the national population growth of 2% year on year.
Yeah, and in which states are we seeing the housing market contribute to relatively strong growth?
So when you compare the performance of that housing component across all the states and territories, it was the Northern Territory that saw the strongest rise nationwide in that housing component in Q1. And that was driven by Darwin's housing prices seeing the strongest price growth through that quarter nationwide. And you saw that Darwin's housing prices lifted nearly 2% Q1. And you compare that to that 0.1% decline across all the capital city housing prices through the same quarter. You did also see that in the housing components within Tasmania, South Australia, New South Wales and the Australian Capital Territory also saw improvements in their housing components in Q1, where in Adelaide and Hobart, what you saw there was an easing in housing price growth quarter on quarter, but it still outperformed the overall capital city housing price growth average, whereas in Sydney and Canberra, while you did see that housing price growth there was still below the average across the capital cities in Q1, they did see still an improvement quarter on quarter.
And just looking now at the fiscal prospects for the states, how are they shaping up?
Just looking through some of the mainland states, New South Wales's budget projections did gain from the assumption of stronger housing price growth there from those RBA rate cuts that are expected to flow through, just to help drive an increase in our forecasted stamp duty revenue there. So the New South Wales budget now expects smaller deficits over the next few years and to reach a surplus in 2027-28. Whereas in Victoria, they do expect their first surplus since 2018 and 19 now in the 2025-26 year, but it is now softened compared to the last mid-year review. You did also see some improvement in Queensland's fiscal position where compared to their 2024-25 mid-year review from December.
Sophia Angala there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, July the 14th. Catch you tomorrow with more reaction to and analysis of Trump's latest tariff moves. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.